Welcome to the Stake New Money Investor EQ series, where we explore the hidden forces that drive investor behavior and how to overcome them to make smarter decisions with your money. If you followed my journey, you'll know that I've been a long-time Stake user, and this series is something we've built together to help people not just invest, but invest well, because managing your money isn't just about numbers and charts, it's about managing your mind. And that brings us to today's episode, building a portfolio that suits your risk tolerance. Let's be honest, most portfolio advice starts with numbers. Put 60% in stocks or 40% in bonds, or just buy the index and forget about it. But here's the problem. It ignores you, your goals, your emotions, your risk tolerance, your ability to stay the course when the market drops 20% and everything inside you just wants to pull the plug. Because a great portfolio on paper means nothing if you're constantly stressed and ready to abandon it when things get tough. And things will get tough. Volatility isn't a bug in the system, it is the system. Markets crash, they correct. This is totally normal. Even Warren Buffett has seen his Berkshire shares fall by 50% at 3 different occasions over his investing career. So the real question isn't what's the highest returning portfolio, it's what's the highest returning portfolio you can actually stick with that suits your goals and your temperament. That's what we'll be exploring in this video. So how do you build a portfolio that suits you? Well, the first step is figuring out what kind of investor you want to be and what your goals are. There are really 2 sliders to think about here. How long do you plan on staying invested, and how comfortable are you with volatility, the natural ups and downs of the market? Those 2 inputs go a long way in shaping what kind of portfolio will feel right for you. For example, if your time horizon is short and you don't want to stress about market swings, say you're 5 years out from retirement, or maybe you're building a house deposit, then you'll naturally feel much more comfortable leaning towards lower risk options. That might mean a greater allocation to government bonds or term deposits where the returns are stable and the risks are reasonably low. You know, if you have a longer time horizon but you still prefer a low risk mindset, that's where diversified index funds and ETFs come in. They may fluctuate in the short term, but historically they've delivered very solid returns over decades. And then if you've got the long-term mindset and you do have the appetite for risk, well, that's where investors can often start incorporating more active strategies like stock picking, analyzing businesses with economic moats and waiting patiently for a margin of safety. So before you think about asset allocation or strategy, just ask yourself 2 questions. How long am I realistically willing to keep my money invested? And how do I respond to volatility? And the great thing is, there are legitimate strategies for almost every combination of those answers. But I will say this, there's one combination I'd strongly recommend you avoid, and that is the short-term mindset combined with a high appetite for risk. That's where I see people chasing big results in short time frames, and often it ends very badly. You may get lucky here or there with a meme stock or some volatile crypto, but in my experience, usually this is where portfolios get hit hard, confidence gets shaken, and people end up walking away from investing altogether. And that's the worst possible outcome. But don't just take it from me. For the next part of the video, let's look at how some of the most successful investors in the world approach their own diversification, because as you might expect, there's no single correct way to build a portfolio. What works for Warren Buffett might not work for Ray Dalio. So how do the best of the best do it? First up, we'll look at the all-time GOAT, Warren Buffett, and the Berkshire Hathaway strategy. This approach is interesting because it's the complete opposite of what most financial textbooks recommend, yet it's yielded Buffett unbelievable results of 20% per year since 1965. While conventional wisdom encourages broad diversification to spread out your risk, Buffett famously said,
"Diversification is a protection against ignorance."
His point, if you truly understand what you're investing in, you don't need to own 50 different companies, just own a few great ones. This is the approach he's taken in his company Berkshire Hathaway. Buffett's portfolio has historically been concentrated in just a handful of businesses. At times, 40% or more of Berkshire's equity portfolio has been in a single company. Now, you might not be comfortable with that, but he is, because he deeply understands the businesses he owns, he has a long time horizon, and is totally unshaken by short-term volatility. There's one combination of those 2 all-important sliders. The upside, if you're right, concentrated investing can produce outsized returns. It's also incredibly engaging for investors who enjoy business analysis and want to be actively involved. But the downside, this approach requires serious conviction, emotional resilience in spades, and a willingness to look wrong in the short term. It also demands deep knowledge. Buffett reads hours a day and has decades of experience under his belt. It is an amazing approach, but also for most people, it's probably not a realistic default option. Then moving on from the Berkshire strategy, the next strategy to talk about is actually the Buffett 90-10 strategy. Yes, again, we're looking to the great man, but this time it's different.
90% of it in an S&P 500 index fund and 10% in short-term governments.
While Berkshire thrives off of low diversification, this strategy is actually the strategy Warren Buffett openly recommends for most everyday investors. In his 2013 letter to shareholders, Buffett wrote that upon his death, the trustee of his estate should put 90% of the cash into low-cost S&P 500 index funds and the remaining 10% into short-term US government bonds. That's it. No fancy hedge funds, no complex diversification, just a simple, low-cost way to ride the long-term growth of the US economy while maintaining a small buffer of safety and liquidity. This portfolio layout speaks to those who have a long-term time horizon and some comfort with volatility, but don't want to take as much risk as individual stock selection. They may also not have the time, energy, or interest to research or follow individual stocks, and this approach gives them exposure to the market without over-reliance on any one company. It's simply participating in the market, not trying to beat it. Now, the upside, this strategy has a phenomenal long-term track record. It's dead simple to execute, requires no ongoing research, and removes emotion from the equation. For investors who want to benefit from capitalism over the long run without having to pick individual stocks or time the market, this approach ticks a lot of boxes. But the downside, well, it's still fully exposed to the ups and downs of the US stock market. So if you're not comfortable seeing your portfolio drop 20% or more in a downturn, then this still might test your nerves. Now, another very common portfolio that you might have heard before is Ray Dalio's all-weather portfolio, a strategy designed to do exactly what the name suggests, hold up in any kind of market weather. Dalio, the founder of Bridgewater Associates, is a big believer in building portfolios that don't rely on predicting what the economy will do next. Instead, the all-weather portfolio is built around the idea that different asset classes perform well in different economic environments, whether that's growth, recession, inflation, or deflation. The classic version of the portfolio includes 30% stocks, 40% long-term bonds, 15% medium-term bonds, 7.5% gold, and 7.5% commodities. Now, that might sound complicated, but the key takeaway is this. It's a portfolio built for balance, not for maximum growth. During periods of growth, stocks will typically shine, but then if a slowdown is occurring, bonds are often a safe haven, or if inflation is running hot, gold and commodities can protect against the erosion of the dollar. Then on top of that, the other element to this strategy is periodic rebalancing. So every year or two, you check in with your portfolio and make sure your allocations still match the original targets, because over time, some assets will outperform others, and that can throw off the balance. If stocks have had a big run, for example, they might make up too large a share of the portfolio. So rebalancing brings everything back in line, which helps the strategy stay true to its original purpose, reducing volatility and performing consistently across economic cycles. This strategy is again tailored to those with a long-term time horizon with only a moderate appetite for risk. The upsides to the all-weather portfolio, the biggest strength is stability. Because the portfolio spreads your investments across asset classes that respond differently to economic conditions, it tends to produce smaller downturns during market crashes. It's also a passive strategy, so it doesn't require constant attention, and historically it's held up well during crises, like in 2008, when most equity-heavy portfolios were getting absolutely hammered. Now, the downside, on the other hand, you do give up some return in exchange for peace of mind. Stocks are usually the best performing asset over the ultra long term, and the all-weather portfolio is relatively underweight stocks. So during bull markets, it tends to lag behind, and it's also fairly reliant on bonds, which brings risks in rising interest rate environments. Another incredibly popular strategy, especially among long-term hands-off investors, is the Bogleheads 3-fund portfolio. Based on the philosophy of Vanguard founder Jack Bogle, this approach is all about keeping things simple, low cost, and widely diversified. The strategy uses just 3 index funds: a total US stock market fund, a total international stock market fund, and a total bond market fund. That's it. With those 3 building blocks, you will gain exposure to thousands of companies across the world, plus a solid foundation of fixed income to provide some stability. It's an elegant solution to a pretty complex problem, and one that doesn't require stock picking, economic forecasting, or hours of research. The biggest strength of this portfolio is its balance of efficiency and diversification. It gives you global equity exposure, cushions against volatility with bonds, and keeps costs ultra low, since all 3 components are passively managed index funds. And because it's simple, it's far easier to stick with, especially during turbulent times. Like Dalio's strategy, the 3-fund portfolio also benefits from occasional rebalancing, and also like Ray Dalio's strategy, the portfolio is designed for the long-term investor with a bit more of an appetite for risk, as it'll only hold 1/3 bonds and 2/3 stocks. The pros: it's globally diversified, very low maintenance, it's backed by decades of strong historical performance. The cons: it won't protect you from short-term market drops, and it might feel a little bit boring if you like to be more hands-on. Lastly, we have the core and satellite strategy, a flexible framework that combines the best of passive and active investing. So here's how it works. The majority of your portfolio, say 70 to 90%, goes into a solid, diversified core. This is typically made up of low-cost index funds or ETFs, like those from the 3-fund portfolio. The idea here is that you create a strong foundation that's really reliable, super simple, and is aligned with long-term market growth. Then the remaining 10 to 30% is your satellites, which is a space where you can get a little bit more hands-on. This could mean investing in individual stocks, thematic ETFs, emerging markets, or even alternative assets that you believe in. It's designed to give you some flexibility to pursue higher returns or follow your convictions without throwing your whole portfolio off balance. So this approach obviously works really well for investors that want structure, but also enjoy some level of engagement. They're in it for the long term, but they are more open to taking on risk. Now, the pros: gives you both stability and flexibility, so you can participate in exciting opportunities without compromising the integrity of your whole portfolio. And the cons: it does require more time and more discipline than a 100% passive strategy. And if you do find success in the satellite portion, many investors can find that as this portion grows, it normally takes over the portfolio, which, while it's a good problem to have, can turn your portfolio into something that you didn't exactly plan for.
Houston, we have a problem.
But for many investors, this approach kind of hits the sweet spot, structured and sensible, and still interesting enough to stay engaged over the long run. So as you've seen, there's no one-size-fits-all answer when it comes to building a portfolio. Warren Buffett, Ray Dalio, Jack Bogle, they all approach diversification in different ways, and each method works for different types of investors. Your temperament, your goals, your time horizon, these are the factors that matter most. And the truth is, your investing style might evolve over time. What feels right at 25 might not suit you at 45, and that's totally normal. But here's the key takeaway. If you build a portfolio that reflects you, your risk tolerance, your level of engagement, your time horizon, well, you're far more likely to stick with it when the markets get rocky. And staying the course is honestly half the battle in investing. Whether you go fully passive, leaning to active stock picking, or build something in between, what matters most is that you've taken the time to understand why your portfolio looks the way it does. Because structure builds discipline, and discipline builds wealth over time. So don't worry about getting it perfect on day one. Just focus on building something you can believe in and something you won't abandon the moment that things get tough. But with that said, thanks for watching, and I'll see you in the next episode of the Stake New Money Investor EQ series.